The latest estimates are that the defined contribution industry will be worth £1 trillion by 2025, so that's not way off in the future. The opportunity for us is to actually look at that savings pot, which is growing, and invest it wisely. That could be, if it's deployed in the right areas rather than just consumed, I think be Britain's version of a sovereign wealth fund.
Okay, good afternoon, everyone. We're joined today by Stephen Welton, CEO of the BGF, or Business Growth Fund, which I think I'm right in saying has invested around 2 billion into 300 startups since 2011.
Very good. Yep. Now over 2 billion and growing. We make more than an investment a week, so I'm now looking forward to 3 billion.
Wow. I think I read somewhere that you're actually the most prolific fund in the world.
Yeah, that sounds
based on that metric.
Yeah, it sounds very grand. But most investors either have really small pots of money, and therefore they're only going to make one or two investments, or you've got really big pots of money, and they're looking sort of for whales out there in terms, again, of giant buyouts. Mm-hmm. We were designed to make lots of investments in a broad range of companies, crucially right across the UK. So making more than 50 investments a year has now put us into a completely different league, partly because we're trying to do something different to everybody else.
Cool. We'll dig into that a little bit more in a moment, but before, to give our listeners some context, it'd be good to get a handle on your background and what your story was, and then how you ended up working or founding BGF.
Perhaps I'm a little bit unusual to some founders. I'm at the other end of the spectrum to many of the people you would normally speak to.
What do you mean by that?
The successful end.
Been long trying to sort this out. I've got quite a conventional background in terms of where I started. So I'm a barrister, so I'm not an accountant. I'm not an investment banker. I decided to do something more commercial, which is why I joined an American bank. And then I worked for them both here and in the US. And I actually got a chance to work in Silicon Valley before it really was Silicon Valley. So before it became the sort of uber cool place to be. But it did give me an early exposure to growth companies. And I thought that was quite interesting. So my career has been a sort of path navigating towards helping to fund and run, I guess, earlier stage and growing companies. And that's been done primarily in the private equity industry, which is hugely successful on a global basis. I think the best performing asset class in terms of alternatives. And its sort of poor relation has often been the venture capital industry, with some notable exceptions. Some of the best funds in the world are venture capital funds. And in terms of how did I get here, I've always been curious. I think that's a good trait in any entrepreneur, trying to just understand how other people run businesses and what opportunities that presents. That curiosity led me to actually go and run a business. So most investors are very good at telling other people what to do. Mm-hmm. They're a little less able perhaps to go and do it themselves because it's harder and it's less predictable. So I ran a television travel and holiday business back in the early part of the 2000s, which was fascinating on a number of criteria. There is an assumption when you run a business that you know what you're doing. That's not always true, but it's reassuring if people think that. And it's also very humbling to see in any company what really makes a good company are the people and how you motivate people, which in the city I think a lot of people have lost sight of. It's not just about money and rewards. It's about passion and motivation and feeling that you're on a journey. That's something you will have heard from a lot of founders. I think that sort of resonates. So I ran that business, which I then sold to Expedia. I went back to my day job as it was. I joined JP Morgan on the private equity side. I was quite happily minding my own business until somebody came up with the daft idea of setting up a brand new company to support small companies in very short order. So the sort of pitch to me was, why don't you try and set up 3i in 3 months? And that is obviously completely ridiculous. But it was sufficiently tempting to actually go and have a discussion with somebody, and that expression that curiosity kills the cat. Well, I'm curious and I'm still alive, but it really was a fantastic opportunity to take all of my experience gained over 2 or 3 decades in terms of working with private companies, working with buyouts, seeing earlier stage businesses, and then thinking, could I apply that experience to a new business which is trying to do something that's really worthwhile? And that's where it all began.
So who was it who approached you?
There were 4 banks. Again, not the obvious source of capital for investment. This was one of the main board directors of HSBC. They were keen to set up a new investment company, and the conversation was a slightly unusual conversation because we started talking about economic history. This is not normally what you do in an interview, but we hit it off in terms of having a sense of the opportunity that was ahead of us. And the banks were keen, and this is after the financial crash, to do something really tangible to support small companies in Britain, not just rhetoric and sound bites. And they were prepared to put their money where their mouth was in terms of a huge commitment to an idea, and an idea which had no people. So this is definitely startup investing on a grand scale. And I was really impressed and attracted to the ambition, recognizing that it may fall flat on its face to start with, but the ambition was big, it was bold, and it had some resonance in history, which is where the conversation about economic history came in, because 3i was founded after the Second World War, very different circumstances, but from an idea. So I do believe in any business and in any investing, you look for precedents and you look for what can make something succeed. So it was a combination of, I thought it was a good time to be doing this, I thought it was a worthwhile thing to be doing, and I believed it could work.
Mm-hmm. And presumably they were offering money on the table from the get-go.
Yeah, anybody who's ever raised money knows that there are strings attached. They were offering a lot of capital, and therefore there were strings attached, but I think it was the size of their ambition that really appealed to me. So the discussions were, we will provide you with up to 2.5 billion. Now that is a big sum of money for a startup. Nobody in their right mind is actually going to give you 2.5 billion in a bank account, but it wasn't just rhetoric. They actually meant what they said. So if you can develop a really credible business, you have a funding runway here of up to 2.5 billion. And that was the thing that really grabbed me in terms of, I would be prepared to take this risk of setting up this business, because if we get the execution right, the capital will be there.
What signs of delivery were they looking for? Because obviously it takes a long time for a fund to mature and show the returns that you build it on. But so when they say get it built, your deliverables within that first 3 to 6 month period, what did you need to show them to start unlocking the capital that they were willing to part with?
That's a great question. I'm a big believer in trying to set realistic expectations. We obviously fund a lot of growing businesses, early stage businesses, and there is an inevitable temptation to promise the earth, especially when you're sitting in front of somebody who you want to invest in your business. And you've got to be careful that's not a Pyrrhic victory. You actually raise the capital, but you set such unrealistic expectations that it's going to end unless there's a lot of good fortune with a series of disappointed parties. So going back to what we were trying to do, I mean, as an individual with potentially access to a large pool of capital, you think, well, that's great. Most startups haven't got the capital, but they've got the team and an idea. So the objectives really for 2011, which was our first year, is actually turn this idea into something that's credible. And what would credibility be driven by? It wouldn't be driven by a flurry of investments. And if you just made a flurry of investments, you're probably going to be backing the wrong things. What would give it credibility is the team. So can you go and hire some people? And that was the first priority. So the very first person I hired was a headhunter. I thought, well, I've got the capital, I now need to get the people. I need to get somebody who really knows where all the investors are in this industry, who may be tempted with the idea of joining a startup. And in the context of our shareholders, it very much was, first thing is to hire a team. The second thing is to start articulating a very simple message. They get some cut through in terms of not so much the media, but in terms of the business community and the entrepreneurs we want to speak to. So judge us by progress in terms of hiring people and in terms of developing a message. Those are really soft targets in a way because they're not financial, but they're very hard targets because you've got to find the people and you've got to find a willing audience in terms of entrepreneurs. And by the time we got to the end of that first year, we had over 30 people and we'd made 3 investments. And my sense was that there was an element of goodwill towards us, that people were prepared to give us the benefit of the doubt. It was almost, well, are you just like everybody else? Well, you sound a bit different, so maybe you are different. And they are simple things to build on. And it meant that at the end of that sort of first year, our shareholders and our board were saying, okay, well, you are starting to make progress. You clearly need to start making some investments as well, but the building blocks are in place.
What was the purpose or mission statement that you used to get people to bandy around the cause?
If you look at the private equity industry and the venture capital industry, they all have one trait that's the same, which is they're investing from limited life funds. So we've created a sort of hamster wheel. You get on the hamster wheel to raise money, you then invest it as quickly as possible, you get it back as quickly as possible with a positive return, you go and raise some more. And if you're successful, that's very, that clearly has worked in the private equity industry. The flaw in that is that you spend a lot of time fundraising. You also spend a lot of time realizing investments rather than investing for the long term. So for us, the critical difference was that we needed permanent capital. There was no point having sort of money burning a hole in our pockets, because that would drive the wrong investment behavior. It would drive a very different culture in terms of the people we hired, and it wouldn't be very convincing to entrepreneurs, because we only ever take a minority stake and we want to be a long-term investor with these businesses. So the structure of BGF was the key thing to get right at the outset, and that has given us the ability to plan and say to companies, we're not going to take you over, so we're not a private equity firm. And that's not a criticism of private equity, it's a difference. So we're not a majority investor. We're equally not a venture capital investor just looking for a unicorn or a needle in a haystack. So if you don't meet those criteria, you'll sort of be cast on the sort of reject pile pretty quickly. We are long term, so we will stick with you for that journey. And we know, and this history has borne this out, very few, if any, companies hit their plans. That's not because they can't hit their plans, it's because they are trying to predict the future. And the reason that works for us as a business proposition is that we anticipate that, and we have the ability and the willingness to be there for the long term.
And entrepreneurs listening will be dying to know exactly what sort of companies you look at and where you source them from.
There's in terms of where we source them from. When we started, we didn't have any companies to talk to.
Yeah.
So we then found one or two. We made a couple of investments, and we got them to stand up and talk to people that they knew. So that's a very old-fashioned way.
I can't imagine it was hard to court people with 2.5 billion being pledged.
It's interesting. It's hard to court the right people.
Right.
I remember going to one dinner, and this lady said, "We sound a bit like Father Christmas," and we all know there are some limitations of Father Christmas. So we're not running a charity. So if you give the impression that this is a grant-giving body, then you'd have a queue and you could give the money away very rapidly. So we're trying to make investments. If you look at the venture capital industry, that is a bit of a sort of, I don't know, it's almost like the film business or the Hollywood business. You want to get the best possible investor to invest in your company because it endorses you. So I think for a lot of entrepreneurs, they want the ideal combination of the money on the best possible terms, so no dilution, with the best possible investor on the planet who's going to do everything with their business. And of course, you can't have all of those elements. So for us, it's generating the right type of demand. And we will not make the same IRRs as a venture capital firm or a private equity firm because we invest for longer. That's not because our investment strategy is worse than theirs, it's different. So we are trying to look for longer term opportunities. And we're looking for businesses fundamentally, and we always start with this, where we feel aligned with the management team. And that is, again, very simple, and I think you can overcomplicate investment. So what motivates the people we're backing? Do we believe them? Do they see a benefit to us, or are we just a sort of commodity in their sort of process, as it were? And if you can build that partnership, you then move on to, well, what is the business idea? Why do we think it's going to succeed? How deep is the team? What are the challenges they're going to face? So it's almost trying to sort of put the normal fundraising cycle of, you tell me a story I don't really believe, and I tell you something that you equally don't really believe, and there's a bit of a dance that goes on to, well, this is the idea I've got behind my business. How would it work? And is BGF going to be a suitable partner for you? And if for many companies we're not the right partner, clearly the fact that we are now such a large-scale investor means we are the right partner for many businesses.
So what stage are they at then?
When we started, again, to keep the proposition really simple, we said you've got to be turning over at least 5 million, up probably to 100, but in reality, most businesses were between 5 and 25 million. So that's not a startup. So they've clearly got something there. Ideally profitable, but many businesses have not got to profit at that stage. And why did we cast the net in that way? Because as a brand new business going to market, you've got to have something that's really simple. If we said we'll look at absolutely everything from everybody in all parts of the UK, we would have just been swamped, and we wouldn't have had any ability to actually sort of carefully build up our business. So we've done that, and that, if you want, is old-fashioned development capital or growth capital. And there is a big need for that in the UK, and we are we're absolutely focused on that and addressing that. We've now built scale as an organisation. We have 14 offices, we've got 180 odd people. So we're the largest investor, not just in terms of volume of activity, but in terms of resources. And what we have done over the course of the last few years is to say, well, now with this infrastructure, with the capabilities that we've got, what else could we be doing to start filling a broader element of that investment landscape? And that has led us to start looking at earlier stage more seriously than we did in the past. So that will take us into the arena, not of complete startups, but businesses that are not turning over 5 million, that are probably loss-making, but have a faster growth trajectory. And a good example of that in the last sort of 2 years is life sciences. Very long term, very hard to predict what's going to happen in that sector, but we've got a group of people who are focused on that, and we are seeing lots of opportunities. And even there, rather than saying life sciences right across the board, we're saying, well, let's pick a subsector to start with. So it's not new drug discovery, it may be more diagnostic related. And what I hope we can do in the long term is to develop what is a really broad investment platform to do more in the earlier stage arena at one end. We also invest on the unquoted markets in AIM at the sort of micro cap end there. So the key for us is to build a large, diversified portfolio of high growth companies, different stages, and then it becomes very sort of inclusive, and that is part of our culture. So rather than, I think the mainstream private equity and venture capital firms, by definition, would say they're very exclusive. We're only going to back 1 in 1,000 or whatever it is, and we're trying to back more companies, and that is very much part of our DNA.
So with those first transactions, some feedback I've got from private equity firms is at a certain level it can get very competitive to actually get hold of the deal. So did you find a lot of competition around the transactions you were initially looking at to try and complete on?
Not really.
No.
And I'll tell you why. Because we're offering something that's different. If somebody wanted to sell their company, lots of competition, and that's a private equity deal. So we don't do that. So we don't do takeovers. Somebody in the early days was looking at a very high growth company and they could fund it with the venture capital industry, they would do that. So what we were looking at, which is why we were set up, is there a big demand for growth capital from a broad range of companies who don't want to sell? That is probably the key thing.
Right.
And that is where we've really built our business. So we are very comfortable with being a minority investor. So we're not sitting there thinking, if only we owned this company, just think what we could do. And that's important to convince entrepreneurs and owners of businesses and family companies you are genuinely a partner rather than a sort of takeover in disguise.
Well, because you can get into all kinds of exotic behaviours, can't you? I mean, some people do asset stripping. They try and get the 51% stake by down rounding the companies. So I guess it is really important to know who you're getting into a deal with.
Yeah, I completely agree. I mean, when we talk to businesses, and it was very hard at the beginning because we couldn't actually substantiate this. But today you say to companies, go and talk to people we backed.
Yeah.
Because they will give you their assessment, they give you an honest assessment. And now we've backed so many companies, and not every business has, as I've said, blown the lights out. Some of them have got there in different ways. Some of them have found it pretty difficult. I would hope that for all the companies that we've backed, at least we are a consistent and a supportive investor. And that doesn't mean, again, that we're sort of very benign and we have no interest in what these companies are doing and we're not trying to make a return. We are. But the mindset is much more, I think it's an attempt to be much more realistic and honest. We know that all these founders are very aspirational and they want to build great businesses, and we share that. But then there is a heavy dose of realism. Okay, well, what happens? What is your plan B? And plan B for too many companies is another round. Well, that isn't actually a plan B. There's another round and it will be dilutive. So going back to your question to me about what did our board and shareholders want at the beginning, we put up some deliverables there. I was pretty confident we could deliver, and that builds credibility. So I think for a lot of companies raising money, they're perhaps, because they don't do it all the time, a little bit naive in terms of what an investor is actually looking for. So I think when we invest now, we make sure that companies go and talk to others.
And how will you play alongside other vested interests in that company? So if somebody came to BGF, gets what I'd call sort of reasonably patient capital on board, but then they have aspirations to suddenly grow it and accelerate it and start, dealing with VCs or potentially more aggressive PE firms. How do you sort of manage that conflict? Or maybe it's not a conflict at all and you're happy for them to grow and sell, but if those aspirations are a little bit more aggressive and maybe short-sighted?
I think that's a very good question. You start, before you even invest, you try to understand what they are trying to do. So as we now do invest in earlier stage companies, by definition, they need to raise more capital. And that's just the nature of that type of industry. So you're trying to set realistic milestones for what will you need to do in order to be able to raise the next round of capital. So I would like to think that we are an experienced, common sense seat around that board table. And we don't have, we're under this advantage, we don't have to make investments. And the fact that we make a lot of investments is because we see a lot of interesting companies to back, rather than we have to make investments because we've got to go and raise more capital. So I think you try to fit the investment to the strategy of the company. And if it's a very fast-growing company, speed to market's important, there's a lot of other capital around doing similar things, then obviously that needs to be reflected in the capital structure and the time frame. If I give you a good example of a business that we backed early on when we started doing earlier stage, which is Gusto. Gusto is doing incredibly well. Now, they have continued to raise capital because they're building market share, they're building a really strong brand. And in that industry, there's probably going to be only one, maybe two companies that survive, because the cost of acquisition is really expensive and you need scale to do that. So their business model has required fast acceleration and building a team, and the CEO has done a great job of that. There are other businesses that we back that are not on such a fast growth trajectory, so they need a different type of capital structure. Maybe they can use some debt as well. And once we've invested and we work with the management teams on board governance and bringing in outside directors, it is suitable in some situations to raise some conventional bank debt. That's obviously something we understand. Our shareholders are banks, so we have a very good relationship with banks. They take quite a lot of comfort if BGF is on the share register, so that's another source of capital. And then if you move into the sort of inorganic growth, so acquisitions, many of the companies we back, they've got to a certain stage and then they want to make acquisitions. It's a different type of financing. So we have the ability here to really say what works in this particular situation, rather than saying we have a cookie cutter approach here. We have to do this, we have to do it this way, and we've got to do it by that time.
You've deployed more capital each year, I think I'm right in saying. Yeah. And how often do you have to raise with that? And is it from the same bank partners, or have you added additional ones?
We're very fortunate that we haven't had to raise at all. So what we've had to do is obviously draw down the capital that was committed. So the 2.5 billion prospect, going back to 2011, was a prospect. We've now invested over 2 billion, so we've drawn down over 2 billion. The beauty of our model is that every time we make a realization, it goes back onto our balance sheet. So our balance sheet today is closer to sort of 1.5, 1.6 billion in terms of realizations that have come back onto our balance sheet. So that we're in a very privileged position because we have a balance sheet. Interesting question for us is, if our pace of investment increases, if we broaden our range of activities, if the hold periods go out because we go into a slower economy, what would happen if we needed more capital? Where would we go for more capital? And that is a really interesting discussion which goes beyond a BGF. Because if you look at it from a UK standpoint, how are we going to raise more capital in the UK? So how would BGF do that? And I think there are some very interesting opportunities that are opening up now in terms of big pools of capital that do not support growth companies in the UK. And that would be pension funds, insurance companies, mainstream investors. And for us, that is actually a very big prize. We would clearly potentially be a beneficiary directly as BGF, but I think the prize is much bigger than just us.
And you've talked a bit about this British mega fund. Is that kind of what you're alluding to there?
If you look at If you look around the world, many countries have a sovereign wealth fund, but Britain doesn't, which is a shame. And we could have had a sovereign wealth fund. If you go back to the 1970s when North Sea oil was discovered, and there's obviously a huge natural resource, many of the sovereign wealth funds around the world are based on commodities. We invested that, or spent it, depending on your point of view. The Norwegians invested it. So if you look at Norge, which is the Norwegian Sovereign Wealth Bank, they're nearly $1 trillion in assets. Norway has the highest per capita GDP in the world. It's only 5 million people, but that shows you the power of a long-term investment strategy. So we unfortunately can't rediscover North Sea oil, and maybe there'll be some other commodity that we discover. But the alternative, I think, for the UK is to perhaps look at places like Canada and Australia and what's happening in the savings industry. And both of those countries have built very, very significant superannuation pension funds, which sounds a bit dull, but they are very sizable, and they are almost a proxy for the financial clout of a sovereign wealth fund. And that is something that could happen in Britain. And the reason it will happen, or could happen in Britain, is that we have moved away from old-fashioned final salary pension schemes, which are fantastic if you are in them, to a world in which the next generation of workers and employees are going to have to save for themselves, because the government is not going to be there in the scale that people will need as we live longer and the population grows. So the government a few years ago did something that sounds very unexciting, which is called auto-enrollment. There are a few interesting software companies, including one of the first companies we backed, actually, that was in that space. And at its simplest, it just means every employee in the country is automatically enrolled in a pension scheme. And the view was that most people would opt out. The reality is most people haven't opted out, which is a good thing, and are saving for their future. I think the average age of a member in these defined contribution schemes is 21, which means they're going to be saving for 50 years. Compound interest being what it is, you save £10 a month for 50 years, it will become a very big number. The latest estimates are that the defined contribution industry will be worth £1 trillion by 2025, so that's not way off in the future. The opportunity for us is to actually look at that savings pot, which is growing, and invest it wisely. That could be, if it's deployed in the right areas rather than just consumed, I think be Britain's version of a sovereign wealth fund. That, if you just take a fraction of that and allocate it towards growth companies, then you would be, you would absolutely be changing the whole landscape.
And what's the prospect of that happening? Is that something that you're working on? I've seen that you've talked about it in a few places.
I'm working on talking about it.
Right. Yeah.
I think you've got to talk about these ideas, so they've got to land.
Yeah.
There was a very significant report this week, which was published by the British Business Bank and Oliver Wyman, the consulting firm, which follows a consultation that's been happening in the investment industry generally, which very much reiterates some of the comments that I've been making. It's giving some third-party endorsement to the size of the market. I don't think anybody debates that this is a huge pool of savings. The debate is what's the best way to invest it. And currently, if you look at it from the standpoint of government, they are very much wearing a consumer hat. This is a big pool of savings, and therefore it needs to be saved responsibly, which is obviously true. If it's too restrictive, then those savings will never grow to the level they need to be to actually meet people's pension requirements when they get older. And again, I'm a big believer in looking at what other countries in the world have done. If you take the endowment funds of the major American universities, so something like Harvard and Yale, they have significantly outperformed many investment institutions around the world because of their investment strategy. So what we're keen to do, and certainly we're putting our sort of views across to all the relevant people, is that these pension funds are given the flexibility to have a broader investment strategy, not to the point where they are speculating and taking vast risks with people's long-term savings, but where they're allocating a portion of that towards higher growth situations, because we believe that will actually increase people's pension pots, and that's what this report said.
And presumably you'd want them to use BGF as a conduit for that?
Yeah, I think we could be a conduit. We don't have to be the only conduit. Yeah, I think if you step back, there's going to need to be somebody who is actually willing and prepared to do this, and showing that you can invest in a diversified basis in scale, and clearly BGF can do that. I'm sure there are others who are thinking about this. And one of the great strengths of the UK in financial services is innovation. And we have created so many different types of products and services over a very long period of time. So I have no doubt that there is scope for us to create something new. Some of that in terms of its delivery will come through fintech companies. So you've got to make people's pensions exciting. So you've got to actually be able to deliver it in a way that it's quite graphic and visual and you can see where your company is going. Some of it needs to be technical in terms of regulation, and obviously a core part of it needs to be investment driven. Where's the capital going to go? So I think if we grasp this opportunity, we could actually make a huge difference to the UK at a time when there is a lot of uncertainty.
And do you think fundamentally this should remain bounded to national interest? Because the example out there in the market at the moment, which a lot of people talk about, is obviously Softbank, and they're getting considerable sums of money from Saudi sovereign wealth funds, etc. And they've simply bloated the size of Softbank's fund just by sourcing international capital. But in this example, do you think for long-term national interest, it's important that it is linked to a sort of homegrown sovereign wealth fund and not drawing on international generosities, as it were?
Yeah, I think that's a really interesting observation. I think Softbank is clearly trying to blow everybody out of the water just by scale.
And it's not working as well.
And there are a lot of views about whether it's working. They're certainly not making a lot of friends in the investment world. I think from my standpoint, there is nothing wrong. And in fact, I think there is a good thing to be open to foreign direct investment.
Mm-hmm.
And I think the UK has always succeeded by being open in that sense, and capital is one flow. But not to the point where that capital is dictating what your investment strategy is. So in my mind, this should be absolutely a British-led strategy supported by British institutions, British pension funds. But there is no reason why you couldn't have some sovereign wealth funds from overseas as part of that. But they would very much be joining a club rather than driving the club.
I think specific with the example that you're highlighting, which is it's attractive to bring in international funding if you're just transacting on it and we take our service fees. But I think you're right. It seems like the Business Growth Fund is looking to create longevity and successful businesses within the UK, which is something that our futures will thrive on, as you say, right up to the point of people's future pension contributions, etc.
And Ireland, I think.
And Ireland.
Yeah, and actually, you've just reminded me of one of the KPIs I had as we set up the business. You say, okay, hire the team, build a reputation. What does success look like? And my answer to that was that we're here in 20 years' time. So 9 years into that, I'm pretty confident we're going to be here in 20 years' time, because if you can survive cycles, changes of government, changes of leadership and your shareholders, you must be doing something that actually is sustainable.
Through some of the toughest times.
What about Brexit?
Yeah, I've heard about that. Well, it's all sorted as of as of recent announcements. I think you have to look at perhaps Brexit in a broader context here. There is a lot going on in the world which is changing very dramatically. Part of this, I think, is as we move more and more towards a service-based economy, we can't live in the past. I mean, Victorian Britain is not going to come back. Victorian Britain had a lot of great entrepreneurs, so that's probably something that we can.
A lot of child workers as well, I'm told.
That was one of the ways in which they obviously create a lot of wealth, and we're not going to do that. So you've got to have enterprise and you've got to have profit with purpose. So business has got to be done in a responsible manner. And that is a combination of people with a good idea. And obviously they can't then exploit others because that's not a sustainable idea. But I think in the context of the future for Britain, with or without Brexit, it's going to be based on future industries. So what we have to establish, again, depending on whichever way Brexit goes, how do we support all the future industries that are going to drive the wealth of this country? So you take life sciences, which we mentioned. We have a phenomenal position already. We've got some of the leading universities in the world, and Cambridge is probably, if you were to choose a city anywhere in the world to do life sciences, you'd probably go to Cambridge. So we need to make sure that we continue to have the best academics, we need to have the best undergraduates, and they're properly funded. And then you start to look across the UK. If you look at the whole renewable industry, Britain is the biggest provider of offshore wind in the world. And sadly, we don't make the turbines, we don't make the gears, we don't make a lot of the parts that go into it, but we are providing the services. So what are we doing to export that and to make this a real centre of excellence? If you look at the long-term demise of fossil fuels, whether that's 30, 40, 50 years, what happens to places like Aberdeen, which is a fantastic place for innovation in oil field services? Can you transfer those innovation skills towards renewables? We think that you can. So the UK has got a lot of clusters of strong sector expertise. You look at healthcare, what we're doing in genomics, in terms of DNA sequencing. I mean, there's a lot of really good things. And the worry with Brexit is that we stop doing those really good things and we start looking inward and not looking outward. And we actually shrink in terms of our ambitions. I think we've got to be very ambitious and we've got to think very globally. And I suppose at the moment, the tragedy of Brexit is that it is so destructive, whether you want to leave or remain. What we see with businesses is they're just trying to get on with what they can influence. And the reason the economy hasn't completely fallen over is because business is continuing to sort of push forward. But it gets harder. The longer this goes on, the more damaging it is. And Britain is just one country in a global economy, and we don't have a right to automatically remain as the fifth largest economy. So that the worry is that we actually just handicap ourselves in a very competitive world.
And when that 2 billion was promised to you back in 2011, that was before Brexit, I imagine was even the remotest possibility. Is there any clause within that promise for that funding? For those banks
no, because nobody was smart enough to anticipate that you'd have something like Brexit. I think they were much more focused on, can you actually make a return on that capital? So we have return criteria that we need to meet, which we are meeting, which we will continue to meet. So I think first and foremost, as an investment organisation, you've got to be driven by returns. Brexit adds in a completely new dynamic. Is that going to make it harder for the UK to grow? And potentially it is, which is why the outcome of this really does matter. But the one thing I suppose history tells us is that there are always going to be changes. And the great thing about entrepreneurs is they're good at taking advantage of disruption.
University.
So we would not, BGF wouldn't be here were it not for the great financial crash. That was Armageddon almost when the banking system collapsed. What we're talking about now is not the banking system collapsing. We're talking really about something which is much broader in terms of international trade and how businesses and countries work together. So it's not going to be as cataclysmic as that. It could be very damaging in the short term, which again is why we need a deal.
And with BGF's aspirations for our companies, what's the desired outcome for acquisitions of businesses that have gone through a good period of sustained growth with you? Because we had somebody who worked extensively in this Swedish startup ecosystem, and a lot of their focus is immediately global because the domestic market is not big enough. Now, within the UK, we have a reasonably decent-sized domestic market. But do you live in hope that a lot of these companies could be, let's say, sold to American entities so that we're actually onshoring capital via sales of these businesses and really are getting your business to stand up on a kind of global platform? Or is it enough to have good, healthy exits and recycling capital within the UK?
There's nothing wrong with exits if that's what the entrepreneurs want. I would hope that we can create some businesses here that don't need to be sold. If you think about Britain as a business model, it doesn't feel the most compelling business model just to take all the early stage risk, the innovation, build something up and then sell it. Why would we do that? It's almost we're an incubator on a grand scale for American tech giants or big global conglomerates. So that's not to say we shouldn't sell some things, but I don't think our business model should be based on that alone. What we have yet to do is to demonstrate that we can create true new global businesses. We've obviously done that historically. You think of the pharmaceutical sector, so Glaxo, or the aerospace sector, with companies like Rolls-Royce. Where are the new modern global champions that we're building? And I think that's what we should be aspiring to. So if you look at the FANGs, they're not British. They're not anything other than American. Why not? And why can't we? So if you take Netflix, obviously a fantastic company, is creating content. English is the predominant language in the world. We're brilliant at creating content. In the BBC, we've got one of the world's greatest broadcasters, but why don't we have a Netflix? And I think that's what we should be partially measuring our success by. It's not all about creating the next Google, but we certainly should have aspirations to create some new industrial and commercial and intellectually driven companies for the future, rather than selling them. And going back to your point about Softbank, Arm is a great company. Arm is now part of the sort of Softbank empire. They clearly made a very good return for their investors. I wonder in the long term whether we would wish that Arm was still based here. So what's going to happen to innovation and investment and R&D in that company in 10 years' time?
Yeah, because they cited the example of Ericsson or IKEA, and a lot of people in Sweden either working for those or working on starting their own thing. But actually they did have, as you said, a lot of kind of global companies that were aspirational for people to work for and gave them real opportunities. And yeah, it does seem we are lacking in those, other than, it's yet to be seen whether sort of the funding circles and stuff like this will meaningfully expand outside of the UK, but it's got to be more than just fintech companies as well, I feel.
Yeah, no, I think you're right. I mean, one of the reasons we've done well in financial services historically is because we have a very sophisticated regulatory system here, which you need. So London was the first place in the world to trade renminbi. And why did the Chinese pick London? Because London's got more foreign exchange trading than any other part of the world. So we can capitalize on that, but we can't just rely on fintech, and we can't just rely on financial services. So pharmaceuticals is an area clearly very global. We have good position, as is aerospace. But the new industries are still very much in their infancy in terms of global leadership. That's where we need to be focusing. And the government is making some good steps in that direction, which is to increase our commitment as a nation in terms of spending on R&D. We spend 1.7% of our GDP on R&D. The G7 average is 2.4, so we're clearly a laggard. The government is committed to get to 2.4. I suppose the question is, why get to where the rest are? Why not get ahead of them? But at least it's a step in the right direction. We've got some great scientific institutions here, research councils. I don't think Britain actually is competitively disadvantaged. Maybe Britain is not sufficiently ambitious.
Do you see within your future portfolio a lot of those companies being deep tech, scientific companies rather than the more, I don't want to say simple, but
they're definitely. Well, I think there is a distinction between businesses that are driven on science and breakthroughs and outlier returns. We are not structured just to invest in those, because that's a very high level of risk, and if it was easy, I guess everybody else would be doing it. We absolutely want to support some of those companies, and I think we can be a catalyst there. We have the physical infrastructure and the investment capability to invest a wide range of different companies. What I would hope is that we can be a catalyst to bring other capital in, because there is a lot of investment, there are huge pools of capital around the world that have capital but not the ability to deploy it. So, which is why everybody's always chasing good ideas. So going back to investments in science in the UK, you've got different pools of capital. You've got the government effectively through something called Innovate UK, which is the arm that invests in deep science, providing grant funding. Who comes after Innovate? There is a gap there.
Mm-hmm.
That's something I think BGF is definitely keen to get involved in, but we're not going to do it all on our own. But could we be effectively the engine to get other people to say, all right, well, if you can build us a diversified portfolio of scientific investments, so we're not just betting on one or two, then as an investment strategy, that makes sense. So we definitely want to do more, but I think we're realistic that to do more, we need to have a broader pool of capital that has a risk appetite to do more. And I think historically, the venture capital industry has been relatively small, so small funds, 30, 40 million, and they are all looking for the same thing, which is one sort of 10 or 20 times return to justify all the investments that don't work. That works on a small fund for the venture capital industry. That will not work for the investment industry because it's too risky. And you've seen some of the recent challenges that the Woodford funds have faced. You've got a few small, very large, concentrated and illiquid investments, and that they're not easy, and they're clearly not easy to liquidate quickly.
Well, and there is an inherent problem with high specification technology that we experience, which is you can't expect the angels to understand the technology often. So they'll come from a banking background or a financial services background where they have spare capital, incentivized by tax schemes to invest, and presented with very high level technology spin-outs of universities. There's no way for them to do technical due diligence, whereas it would be quite reassuring if a fund on behalf of the next step from Innovate UK does that, and people can start to get confidence from the sort of process that they're going through to understand the technology and be invested in that space.
Yeah, I think that's a really insightful sort of comment. I agree with you. If you look at most private investors, they probably fall into two camps: those that will stick to an industry they know really well, which is where they made their wealth, or it will just be a little bit of serendipity. I met somebody in the pub, a mate of mine's invested in this, why don't you invest in this? That isn't an investment strategy, that's sort of potluck. Where there is I think a role for the private banks in the UK and the wealth managers is to come up with essentially a fund of fund type product to give diversified exposure. because I think if you could go to private clients who are investing through EIS and somebody's going to invest £100,000, you can either invest your £100,000 in 2 or 3 companies that you picked, or you could invest it in 20 companies that somebody else is managing, and you've got a big pool. I think that is a really interesting direction of travel, because I think it meets the needs of private clients to have diversification. It creates a genuinely long-term pool of capital, because private clients are permanent. I mean, until they obviously are not here, they've got longer-term horizons. I also think it addresses another interesting point, which is a much more emotive element, which is having a stake in society. And if you look at some of the sort of, get back to Brexit, some of the underlying drivers for that, people feel that society's unfair. It's divided into people at the top who've got a lot, and then everybody else. We need to make sure that everybody realizes they do have a stake, and you have a stake through your savings. But at the moment, that's all very opaque. And I think there is definitely scope to do that. So bringing in private clients in a more managed fashion is something that we can do. And if you go back in history, we have done. So we created investment trusts in the 19th century, which is a large pool, diversified quoted vehicle.
We've got about 5 minutes until we're unceremoniously turfed out. So do you want to do the quick fire?
Yes, absolutely. So just a couple of quick questions now. We just like to ask you first for a prediction for the future.
I think the British economy is actually going to be more diversified, more dynamic, and better positioned in the next 50 years than it has been in the last 50 years.
And that's not just rhetoric?
No, I genuinely, partly because if you look at what we were based on in the last 50 years, those industries are going away. So we have to, otherwise you will have serious problems. So the industries of the future are up for grabs. And I think providing we focus our attentions on that, we could do really well. And if to give a specific, you go back to genomics and you look at the National Health Service. Nobody else in the world has a National Health Service. We're not going to get rid of the National Health Service. That is an amazing institution in terms of the healthcare it provides. It's also an amazing investment opportunity. So if we get behind things like that, we would be in a phenomenal position. So I do genuinely think Britain could be a stronger economy going forward, because the economies of the 21st century are going to be knowledge-based. They're not going to be industrially based. So that's why I would be confident. But like most predictions, it will very much depend on what you do about it. It won't happen by itself.
Yeah.
Well, as you say with the NHS, it's a fantastic tool for gathering huge amounts of patient data in one place, which now we can manage that data is actually a highly effective way to manage further developments and innovations within that ecosystem. Second question is, do you have a startup book or resource that you would recommend, or any book at all, actually?
Or, business rather than...
Yeah.
I'm not going to give you a specific book. I'll tell you what I find increasingly useful, which is the power of data. So my strong advice to people is just read a lot around the subject that you are actually reviewing. So if you take a very simple thing like the newspaper, I used to read 1 newspaper a day, now I read 4. And I'm often reading the same articles or the same content, but written from a very different standpoint. And that creates curiosity. It also gives you perspective. I think with a lot of businesses, they become very one-dimensional. I have a plan, and this is my plan. Other people may have a plan which could impact on that. So read broadly, always be questioning. And, as a very simple thing, whenever we have investment committees, I'm always looking on the internet as people are talking about, well, you've talked about this competitor, what are they doing? Do you really think they're doing what you think they were doing? And that sort of questioning mind. So books are part of that, information is part of that, meeting lots of people is a part of that. So I would say be very curious and always be questioning. And the best entrepreneurs I've met are sort of vaguely paranoid because they think somebody's got a better mousetrap and is just about to be launched.
How long does it take you to read 4 newspapers a day?
I'm a speed reader.
Okay.
So there is I can't remember the name of this entrepreneur, was a chap at school, he was about 15 or 16. He worked out that most newspapers have a headline, a first paragraph, then they repeat everything, and then they have a conclusion. Yeah. So if you read the headline, the first paragraph, and the conclusion, you probably covered 80% of what's in there.
Top tip.
And which 4 papers are they, given that we're in the Daily Mail building?
We're in the Daily Mail building. It's not the Daily Mail. Sorry about that. It would be the Financial Times, which is where I started, the Times, the Telegraph, and the Guardian. And then the Economist, but that's obviously a periodical.
I think you may have nailed the best advice that we could be given. Best advice you've ever received?
It's very simple. Hire good people. That's great advice. It's harder to execute. But if I go back to when I started as one person, I mean, one person can do so much. 180 people can do a lot more. And I asked somebody who had been very successful in business in all sorts of different realms, and that's what he said to me. And it is blindingly obvious. Because my question to him is, well, how can you possibly have done all of these different things? And he just said, well, hire good people. So I think that is finding them, making sure they're the right people for your business, making sure they're onboarded properly, that they share your goals and objectives is all key. But there is no doubt good people is what makes great businesses.
And then finally, from either a BGF perspective or a Stephen Welton perspective, is there anything that you'd like to ask our listeners?
I'd like them to be honest in terms of why you are in business, or what your motivation is. I think especially with the next generation of founders, and one of the reasons I'm optimistic about the future is that we've never had more startups, we've never had more people wanting to set up their own businesses. I also meet many people for whom it didn't quite work out the way that they thought. So I suppose the question is, if you are going to set up in your own business or get involved in an early stage company, do you really want to be doing that, and what is your motivation? Because the key thing, which I think transcends age, is a passion for what you're doing. So my question would be, are you really passionate? And then are you able to be very objective about your passion? Because is it just a great idea that will never really develop, or is it a great idea which, with hard work, you can make into a really interesting business?
Stephen, it's been a great deal of fun. Thank you for coming on.
Pleasure. Very nice to talk to you both.
Thank you, Stephen.
Cheers.